At Life Insurance Strategies Group, we spend a lot of time explaining the compensation model of life insurance products to our clients. Now, it's rightfully so that they would want to understand this because the amount of money that they're spending ranges from hundreds of thousands of dollars a year for a retail contract to $100 million a year for a private placement annuity. So tracking the compensation and how that might impact the product's performance is of key concern. So the three different ways that life insurance brokers are typically compensated from life insurance products are heaped commissions, levelized commissions, and asset-based commissions. So heaped commissions are generally found in your retail products, where the client pays the premium and the life insurance producer usually receives a commission that might be around that annual premium payment, more or less. Now, how does that impact the product? Well, over the long term, not very much, but in the short term, well, short term being relative, the first 10, 15, 20 years are surrender charges in this product. So if the client were to surrender the product, they would be, in essence, making up for the commissions that had been paid heaped up front. Levelized commissions are when, typically in contracts where you're going to see high early cash values. So let's say the premium is $1 million. Instead of paying $1 million and the client seeing a surrender charge of $500,000, they might see a cash value of $975,000. So in exchange for this high cash value and a low surrender charge, the compensation is then levelized, meaning it might be paid out over a period of 4 or 5 years instead of heaped all at once. It's still a version of heaped, but again, levelized. And we see those a lot of times in premium financing situations where banks are lending against policies, so they want to see a high cash value. And then asset-based compensation is the third way that we see brokers compensating. This is common in private placement, where let's say the client puts $100 million into a private placement annuity, and then just like the asset manager, the insurance broker earns an asset-based charge. So that might be, say, 10 basis points, 15 basis points a year on the asset value of that annuity or life contract. Also in the retail market, we're seeing an explosion of fee-based products where the person selling the product, say an RIA, can earn compensation on the asset-based trail similar to as done with private placement. So if you have questions about how your broker might be compensated on your product, reach out to us at lifeinsurancestrategiesgroup.com. We don't sell products, but we help our affluent clients solve complex life insurance matters.